So how do we estimate the risk of an investment? For most financial assets, analysts typically rely on historical data. They look at past returns to estimate an investment's risk. For example, when evaluating Coca-Cola stock, analysts might use monthly returns over the past 5 years to calculate standard deviation. This approach gives us a sense of how volatile the stock has been in the past. However, it's important to note that past performance isn't always a perfect predictor of future outcomes, especially for industries undergoing rapid change like tech and renewable energy. While historical data is a useful starting point, analysts sometimes adjust their models for unique situations. For instance, when evaluating a new IPO like Rivian, an electric vehicle company, historical data might not exist. In such cases, analysts have to rely on forecasts and comparable company data. So this method of using historical data underscores an important point. Understanding risk requires both statistical tools and sound judgment about market dynamics. So the formulas for historical returns can be found in Excel. It's the formula equals average, and then you have the sample data. Likewise, if you're looking historical data, to estimate standard deviation, it's STDEV, and then the sample data. That will give you the calculations of both risk and return for a series of returns for a particular company or asset. So here we have 3 assets. We have the stock market, we have a company called Blandy, and a company called Gourmand. So these 2 companies, we're going to look at them, try to understand their risk and return, but we're also going to make some comparisons and try to understand how they relate to the stock market. Now we have a historical returns worksheet that can help us do these calculations fairly quickly. So we input the data. Here are the returns. If you notice, we only have 10 years here. In the spreadsheet, you can go up to 48 months. So we can go up to 4 years worth of data. One point you may know is you need to input here as a data point the number of periods that you have in your example. So in this case, we have 10 years, or 10 months in this case, 10 periods, if you will, of returns for these investments. If you notice, Blandy has a 6.4% average return, and Gourmand is 9.2%. The standard deviation, 25.1, almost 25.2 for Blandy, 38.6 for Gourmand. So we can see that definitely Gourmand is a more risky stock. So again, analysts often use past risk as a predictor of future risk, but past returns are not a very good predictor of future returns. We can calculate the rates of returns on a portfolio once we know the returns of the assets within the portfolio. So in this case, portfolio risk and return, the portfolio returns are the weighted returns of the assets within the portfolio. The proportions are based on the amounts invested in each asset. So for example, for a 2-stock portfolio, if we put 75% of our investment in Blandy and 25 in Gourmand, and notice that these are backwards, we see that the average return, it's 75.75%, the money invested in Blandy times the return on Blandy. Add that to 25% invested in Gourmage and multiplied by its return. So again, back to our table. Here are the returns for each of the assets. If we wanted to do this, we could multiply each one of these, this one by 0.75, that one by 0.25, that's 31%, and then average those all up. Of course, it's much easier to do in Excel. So in Excel, we have our weights, 75% times each one of those weights, 1 through 10, or returns. 25% times the returns for each period of the other asset. Add them together. Again, we just repeated that last table. This tells us that the average rate of return for this portfolio, 75% in Blandy, 25% in the other, 7.1%. Standard deviation is 22.1%, has a coefficient of variation 3.12. So let's look at these combined together here, right? Portfolio risk looks at the combined risk of multiple investments held together. One of the most powerful tools is what's referred to as diversification. Diversification reduces risk by combining assets that don't move in perfect sync. For example, suppose you own shares in both ExxonMobil and Tesla. When oil prices rise, ExxonMobil stock may perform well, while Tesla stock might decline because of higher energy costs could affect electric vehicle demand. The opposite might also occur if oil prices fell. By holding both stocks, you reduce the overall volatility of the portfolio. In this instance, we see that the average of the portfolio is between the two stocks, between Blandy and Gourmage, 7.1%, but the actual standard deviation of the portfolio is less than either one of the assets in the portfolio. This is that description of diversification. The key to diversification lies in the correlation between assets. Correlation measures how two assets move in relation to each other. If two stocks are perfectly correlated, there won't be any reduction of risk through diversification. However, if they are negatively correlated, perfectly negatively correlated, adding them together can significantly reduce risk, even to the point of eliminating it entirely in some cases. We can calculate risk in Excel using the Excel function equals correl, and then the column of stock returns and the column of the other stock returns. So the correlation between Blandy and Gourmage, right here, here's Blandy, here's Gourmage, is 0.1125. If we also, while we have it here, look at the correlation between the stocks and the stock market, we find here that the relationship between Blandy and the market is 0.48, and between Gourmage and the stock market is 0.67. So the relationship between Gourmage and market is much higher. They're much more closely related to each other than Blandy and the market. So again, here's the key question. What happens to risk as you add more stocks to a portfolio? Research shows that as you increase the number of stocks, the diversifiable risk or the firm-specific risk declines. However, some risk always remains, and we refer to that as market risk. So where do we get this diversification? Again, if a correlation is -1, those stocks can be combined and can have very, very low risk, maybe even zero risk. If the correlation is +1, risk cannot be reduced at all, right? The standard deviation is just a weighted average of the two stocks of the standard deviations. However, if it's between -1 and +1, which is where we think most things are, obviously, risk is reduced but not eliminated. So real-world portfolios demonstrate this principle. Many investment funds diversify across industries, geographies, and asset types to minimize risk. For example, a mutual fund might include tech companies like Apple, healthcare firms like Pfizer, consumer goods products like Procter & Gamble. What's the takeaway? Diversification doesn't eliminate all risk, but it can significantly reduce the risk associated with individual assets. Again, a key question. What happens when we add stocks together? Market risk is left. For example, if you buy just one stock, say Apple or Alphabet, your risk is tied entirely to that company's performance. You would have, on average, the average stock has a risk of about 35% standard deviation. However, if you put together 20 or more stocks from different sectors, you've reduced the impact of any single company on your overall risk. However, the total risk will not go below what we refer here, 20%, which is what is called the market risk. So even a well-diversified portfolio is exposed to market risk. The risk associated with macroeconomic factors like interest rates, recessions, or geopolitical events. This is why a diversified portfolio still reacts to major market downturns, such as the 2008 financial crisis or the 2020 pandemic. So a practical lesson here is that diversification works best when investors combine stocks with low or negative correlations and when they accept that some market risk is inevitable. So market risk is that part of a security's standalone risk that cannot be eliminated by diversification. Firm-specific or the diversifiable risk is that part that can be eliminated. As you add more stocks together, each new stock has a smaller risk-reducing impact on the portfolio. It falls very slowly after about 20 to 40 stocks. So the lower limit, per our previous graph, is around 20%. So by forming well-diversified portfolios, investors can eliminate about half the risk of owning a single stock. So market risk comes with everything, right? It's part of an individual stock. How do you measure the amount of market risk that an individual stock brings to a well-diversified portfolio? William Sharpe has developed the capital asset pricing model to answer this question. And quite frankly, there were actually 3 models, all developed at the same time, but they all came up with the exact same formula or the exact same relationship mathematically between risk and return. We'll talk about that in the next video.